This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil prices settled more than 2% lower on Friday as supply concerns driven by Middle East tensions eased. While jobs data raised expectations the U.S. Federal Reserve could be done hiking interest rates in the biggest oil-consuming economy. Brent crude futures were down $1.92, or 2.3%, to $84.89 a barrel. U.S. West Texas Intermediate crude futures fell $1.95, or 2.4%, to $80.51 a barrel. Both benchmarks settled down more than 6% on the week.
Russia's energy ministry said on Friday it expects the country's exports of crude oil and petroleum products to fall in November by more than 300,000 barrels per day, BPD, compared to the average level in May to June. The ministry also said that Russia is continuing to participate fully in voluntary efforts by OPEC+, the group of leading oil producers, to stabilize the energy market. Saudi Arabia and Russia have agreed to continue with voluntary oil supply cuts totaling a combined 1.3 million barrels of oil per day, or more than 1% of global demand, until the end of the year.
Moving on to the top news in the energy sector.
Energy giants offered a rare glimpse into their liquefied natural gas, LNG, trading strategies in recent days, with Shell's and TotalEnergies' bets on rising Asian demand paying off while BP's bet on a European deficit turned sour. The contrasting outcomes highlight the risky nature of trading divisions, at times notching up spectacular profits as traders quickly exploit price swings and supply and demand disruptions around the world to make money, but at other times losses have been just as spectacular. Companies rarely reveal details on their trading activities beyond general commentary on their performance, but executives this week shed some light on their performance in the third quarter.
The U.S. House of Representatives easily passed a bill on Friday to bolster sanctions on Iranian oil in a strong bipartisan vote. The Stop Harboring Iranian Petroleum, SHIP, bill, which passed 342 to 69, would impose measures on foreign ports and refineries that process petroleum exported from Iran in violation of U.S. sanctions. U.S. lawmakers are debating several pieces of legislation to pressure Iran after the October 7 attacks on Israel by Hamas that killed at least 1,400 people, mostly civilians. Hamas has long been backed by Iran, but Tehran has denied any involvement in the attacks. Next, we have the top news in metal markets. The Carbon Border Adjustment Mechanism, CBAM, proposed by the European Union creates a new trade barrier for Chinese exports, China's state-backed steel association said on Friday, calling for more talks with the bloc to address climate issues. The EU approved in April the world's first plan to impose a levy on high-carbon goods imports from 2026, targeting imports of steel, cement, aluminium, fertilizers, electricity, and hydrogen. The levy would pose a big threat to steel producers in China, the world's top exporter of steel, as long as their production remains more carbon-intensive than in the EU.
Copper prices rose in London on Friday as the dollar continued to weaken after U.S. jobs data, offsetting the bearish effect from higher metal inventories in exchange-registered warehouses. 3-month copper on the London Metal Exchange was up 0.4% at $8,173 per metric ton by 1700 GMT. The metal is up 0.9% so far this week, heading for a second week of gains. The dollar fell to its lowest since September after data showed the world's largest economy created fewer jobs than expected last month, reinforcing expectations that the Federal Reserve is likely to pause hiking interest rates again at the December meeting.
We will now look at the top news in the agricultural sector.
Global palm oil output is likely to drop next year due to the impact from the El Niño weather pattern, while demand from the edible oil and energy sectors is set to grow, supporting prices, leading industry analysts said on Friday. Hot and dry weather is expected to continue into early 2024, worsening a steady downward trend in yields of palm oil from top producers Indonesia and Malaysia in recent years. Global output of palm oil, which makes up a big chunk of the edible oil market, is expected to grow by 0.2 million to 0.3 million in 2023-24, the lowest rate in 4 years, said Thomas Mielke, head of Hamburg-based analyst firm Oil World.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.